Hello, and welcome to the Global Markets Podcast. The aim of every episode is to provide you with value and knowledge that enhances your finite time on Earth. Thank you for spending this hour with us. So I'd like to start off by asking you, what role does collaborating with industry experts and corporate executives play in achieving outperformance? Public markets are currently a highly efficient and highly competitive environment. So if one seeks to outperform, one must gain an edge over their competition. Commonly, people will reference an informational advantage as a means of gaining a source of outperformance. To what extent has this played a role in your investing journey?
Yes, I'm the one putting the money in. I'm the one putting the decision at the end of the day to do it. But the learning potential, I mean, frankly, it's from all the different conversations I have with these various experts. They all work in different fields, and I am there just to try to be a sponge and put the puzzle pieces together to then form an idea. But I don't have a PhD in chemistry. We have people with PhDs in chemistry, and they can be instrumental in understanding, different businesses. We people who work in cybersecurity, who are very technical in their fields, and they know, what CrowdStrike's product is, like the back of their hand, and they can hopefully kind of give me some nuggets of information and then hopefully I'm there and open-minded enough and able to put those puzzle pieces together to then understand, okay, what may or may not be the opportunity there, or in network connectivity, or cloud software engineers, or in various parts of advertisement technology. Those are the things that I think has been instrumental in sort of achieving this performance, because it's both being able to talk to those people, but then at the same time, I think it's being able to absorb and then sort of put the pieces of that puzzle together to get a clearer picture of what is actionable, what is there to do. Now, as far as the other point that you made about underallocating to another industry, et cetera, if I actually look at my portfolio, hindsight 2020, but if I look at it and if I look across all, my investing career, there has been fair to say just a few names per year that have driven the vast majority of the performance. And most of the time, it's come from opportunistic periods of time where the market, the market participants are just very much disillusioned with that sector. And it's been through varying reasons, right? It's not always the same reason, and that's the beauty of it. It can rhyme, but it never repeats. History is not repeating. So, for example, the era of 2022 was wonderful, but there was 2020, of course, and different things were more punished than others. And then trying to shift through that rubble and pick out what are the diamonds. Maybe I don't pick out the perfect diamond. I don't pick out the best gem, but I pick out something in there, and no one really cares to pay attention to that. So I'll give you an example. So in 2021, in 2020, apologies, there was energy. Energy was right there for everyone to kind of shift through. You could have picked almost any. I ended up picking Occidental Petroleum and ConocoPhillips. But you could have picked ExxonMobil. You could have picked, well, Chevron would have been a little bit worse than those, but there were others that also did phenomenal. And maybe I didn't pick the best one. And honestly, I'll tell you a mistake I made. I actually took profits too early on Occidental Petroleum and grabbed that capital and put it
Did
in
you initiate the
ConocoPhillips.
position in
That was a
Occidental Petroleum
portfolio
prior to Berkshire Hathaway opening a position?
blunder, because I actually
Sorry
no,
to interrupt. Did you?
no,
Okay. Did you get the idea from them?
no, no. I
Okay,
was already
that's good.
looking at Occidental Petroleum because of Anadarko acquisition that they had done. And then during the initiation of the position was actually right before the election results.
Mm-hmm.
And so the election of 2020 with President Trump and President Biden, the thesis around it was potentially, it doesn't even matter that if there were any actual policies implemented, but the Trump administration had loosened up the ability for people to drill oil. And it didn't have to be necessarily, and that was a thought process at the time, it didn't even have to be an actual change in policy. Just the very sentiment that there would be policy change or restrictions could be enough to change behavior of the oil majors within at least the United States to slow down drilling, to slow down new projects because they don't want to deal with the hassle. And so whether or not that actually was the most or the largest contributor to the returns is almost irrelevant, but you can make the argument, hey, that actually wasn't the real reason why you had all this massive performance. But at the end of the day, I looked at it as saying, I have an asset here that it's one of the worst sell-offs that we've seen in recent memory, an asset that's been underperforming since about 2015, since the shale boom, and people are even saying, you have Cathie Wood coming out and saying oil is dead, it's done, it's forever gone. So when you have the shoe shiner, and I am, when she's saying something that she has no idea what she's talking about. And recently, we can talk about her comments on the Great Recession, right? Or the Great Depression. Apologies, even worse, Great Depression. That we're in a new Great Depression. When she's saying stuff like that, you kind of want to look for doing the opposite of what someone like that says. But yeah, that going back, there are every year there's some sort of theme, it seems. And in 2021 there was, of course, you had the meme stock bubble, but there were sectors. I'll give you one. I played this one actually the worst. So I invested in Cardinal Health, ticker symbol CAH for the audience, and there were three big players that you could have picked from. I picked the worst one. There was AmerisourceBergen, ticker symbol ABC, and then there was MCK for McKesson. So all of them had the same thing going on. There was the lawsuit from the opioid epidemic, and the lawsuit had been going on for, I think, since 2015. And you could pull up a stock price chart for each of them, and you could see that they were dead money. So this is something that 3M will go through, by the way. If I had to make a bet, a fun honor bet, 3M is going to go through this as well, or something similar to this. They're going to do a master limited settlement at some point, but you don't know when that's going to happen. So it's dead money until then. And so it could be, many years. But I made a calculated bet that the decision would terminate or conclude sooner rather than later. And I was already kind of penciling out some concerns. I made a lot of content on the liquidity crunch. But Cardinal Health was actually the worst one I could have picked. But you can see, again, back to what we were just discussing, themes and sectors that are often just thrown out and hated. And I think a lot of times, if I attribute a lot of the return success has been to finding those themes, and when a whole sector's hated, that one you can try to find what are the quality players. Because if you have an environment where, let's say banks are doing great, banks are going to the roof, and you're picking the bank that's trading terribly, it's going down and down and down and down, and you're thinking you're that guy, you're picking the diamond in the rough. No, more often than not, you're probably just picking the bad player, and there's a reason why the market is punishing it. But when everything is selling off, well, then that's the time that you want to find something worthwhile. So yeah, and we can go on. There's plenty of examples actually in the past several years that I've participated in. Right now, actually, you want to talk about one that hasn't played out yet, but I'm still confident is REITs. I'm waiting on this one, but that one, everything's thrown out right now, and I have confidence still to say that one day, if you pick out some diamonds in there, you'll do all right.
So, just for the audience, can you outline the ongoing reason for the pessimism surrounding REITs, like the interest rate risk, nature in which they finance debt for expansion, so on and so forth, and then also the potential opportunities in the space?
Of course. So a REIT, a real estate investment trust, is simply an entity that utilizes investor capital to purchase and own real estate and sometimes manage real estate. Just to clarify, you want to make sure that the REIT you're looking at is internally managed, not externally managed. So be very careful for that.
Why is that important?
because the incentives matter. I'll show, Charlie Munger said famously, show me the incentives, I'll show you the outcome. If your management team isn't aligned with you perfectly, your results will probably be worse. The management team might do acquisitions that aren't very accretive. But in short, a REIT is simply attempting to establish a spread, just like a bank, between the cost of capital and the assets that they acquire. In this case, it's real estate. So you'll have a REIT that borrows money at, I'm making up numbers, 5%, and buys a property with a cap rate of 7%. That's a 2% spread, and it's doing a mix of, within that cost of capital, of debt and equity. If there's drawbacks to both. A lot of debt is cheaper long term, but more risk. A lot of equity is less risk, but more expensive longer term, because when you use equity as a form of capital raise, you are giving up future profits or funds from operations or cash flows from those real estate to more investors. But it's a less risky proposition, because at the end of the day, there's no time stipulation or expiration or forced payments that have to come about that. So why are REITs an opportunity? Well, right now, cost of capital has risen quite drastically from, let's call it, the past 5 or so years. And for REITs, since the cost of capital has risen up, you would think that the assets that they're acquiring would also reflect that rise in cost of capital. No. So right now, REITs are in a very weird position where the cap rates for the real estate that they're acquiring, it has not actually corrected yet. It's a little slower, but both REIT share prices, which again they use equity to get capital to buy this, is now really expensive to use because the share prices are suppressed. And then on top of that, the actual debt markets are not offering very attractive rates right now for them to then go and acquire those assets. So the growth has been stunted across the industry, and the private markets and the public markets are almost disconnected in real estate. So right now, you could make the argument that there could be two scenarios that unfold. Either the public markets recover and the private markets were right the whole time, or the private markets are going to correct to where the public markets are. So as in, private real estate values will decline, and depending on what market we're talking about. And I think we have some evidence to say that that is actually what's happening. Whether you look at office real estate, whether you look at commercial real estate, whether you look at even in industrial real estate in some markets. And for the time being, I think that if you look at REITs, they are really well capitalized compared to historical standards, meaning that the leverage rates are quite low. If you go out and buy a property, you're probably going to use a lot more leverage than what a REIT is. REITs right now, our average leverage is maybe about 50% to the value of the property, or to even if you look at book values, to the net asset value on the books for the real estate, a lot of these are trading at historical lows. And I'm talking about levels not seen since 2008, which is pretty incredible. One of them, I'm not to talk my book here, but KRC, which is a A-class REIT, in terms of the properties that it owns in San Francisco, Los Angeles, and even parts of Texas, they are trading at, I think, off the memory, 0.6, maybe a little higher, a little lower. And for the audience to get a little bit technical with the accounting, when you look at the real estate value, the book value on the balance sheet, you need to understand that that's not the actual market value. The market value could be higher or lower. It's irrelevant. Right now, just think about it this way. The market value, most of the time, is going to be higher. But what you're seeing on the balance sheet is actually what they paid for it minus any depreciation. So if you've held a portfolio for a decent amount of time and you're trading under the NAV of that, that's pretty let's call it pessimistic to say that a REIT should be trading at 0.6 the book value of the real estate, because for all we know, it's hard to really tell. You can only get an estimate of what the total market value of the real estate, unless management tells you their assumptions and you just take your word for it. All you have is an assumption. Then you could say that the historical valuation of these REITs, just on that metric alone, are extremely cheap. I don't think all REITs are created equal. I think that depending on what REITs I'm talking about, I can be a little bit more bullish. For example, I'm not the biggest fan of office because I think it's very cheap, but I think that as an asset class, it's not the most attractive you could get involved in. I think, companies like Sun Communities, now that's the real estate I love. Um, and you could argue that, industrial's very attractive, but I think it's sort of crowded. But frankly, it's warranted. It is an attractive asset class. But yeah, REITs in general, I think you kind of throw a rock, you'll find a REIT that's trading at a decent discount to where it historically trades at. And I think you could argue that it will generate good returns, especially if you think cost of capital does decline in the future with where rates may go. So if rates decline,
Do you think there's concern about the variability of interest rates and the fact that financed a large portion of their outstanding liabilities with variable rate debt? Is that a concern at all?
yes, it is a concern. So if you're looking at, and that's on a case by case basis, if you're looking at a REIT that is utilizing right now a lot of the variable rate debt, you are making a bet. The REIT is making a bet that rates are not going to increase from here, but they could. We don't know that. We don't know for certain. And so, as an investor, you got to be just very aware of how each REIT is exposed. Different REITs, and they'll tell you in their presentations. I can recall like WP Carey has a slide that if you go to their slide deck, you'll see the breakdown of how much is fixed, how much is variable. And then you as an investor will determine what risk appetite you're willing to take. How confident are you that rates are going to come down? If rates are going to come down, you should know more or less which REITs are going to benefit from that the most. Um, so obviously, REITs with higher amounts of leverage and maybe more debt in the variable side are going to actually get the most relief and the most share price appreciation just from the change in circumstance than the ones that have a bunch of low rate fixed debt and they're not as punished. So I can think of like, some of the REITs that come to mind in the office space is like Brandywine, which I don't have an investment in. I know that some of the club members have forayed in this investment, and I think the ticker is BDN off memory. But that one, if you look at it, the leverage ratios are quite high versus a company like a Kilroy. Um, the property type, it's a mix market actually for good, I would say good reason, doesn't like REITs that over diversify by asset class, but um the debt is really, I think, the main concern. And if rates were to come down drastically, I think something like a Brandywine will outperform Kilroy, but consider the risk. So um yeah, I think it's just case by case basis, but yes, you do want to be very careful with how the debt stack looks like and the maturities, right? Because when does the debt mature? If you have a lot of maturities in the next couple of years, well, you're going to have to refinance. Most of the time, REITs just keep refinancing, but you're going to have to refinance that at higher rates.
Why do you think that the bulk of REITs chose to pursue variable rate debt, and why in the sort of 2020 to 2021 period of ultra low historic interest rates, why didn't they just fix the majority of their debt?
So for a couple of reasons. So a lot of the variable rate debt for REITs, they you could make the case that the management teams did a blunder. They did the this is actually something that I spoke with Andrew, one of the capital markets analysts, about that despite everything, and you think, there's a lot of really intelligent people everywhere in any field. People fall for it all the time, and I implore you, your audience, to actually take a step back next time something happens and just observe whether we're right now. Try to think about right now. Try to think about something that happened 5 years ago, 2 years ago. People tend to take the current dynamic, the current situation, and extrapolate that out into the future as if it's going to be reality forever. Let me give you some examples. Because I'm trying to make the point that really smart people, they can be really smart, really well educated, a lot of experience, and they'll fall for it. They'll fall for it, and I think that's what happened. But take the in the REIT space actually itself, work from home. So 2021, the year is 2021. The audience, go back in time and try to remember that period. I'm trying to take an example that's not too far long ago. What were people saying? Well, people were saying that, the office has changed forever. Yes, it has. I would argue that it has changed forever. But what were they saying? Well, we were all working from home. If you're, an office job, you probably were working from home. Your whole office is working from home, and you're working either the whole week or maybe coming to the office one day a week, if at all, and depending on what state you live in. And a lot of people, and a lot of market participants, a lot of pundits, everyone, saying this is how the office is going to be. All these companies, they're going to cancel their rents. They're not going to go to the office anymore. Productivity is amazing, etc. And take that moment and say, well, now you live in the now. The day is June 20, 2024. What's happened? How did that play out? How correct was that? Well, turns out no, none of that was correct, at least to the T. It was correct in the sense that it has changed forever in maybe the technology we use. We use a lot more Zoom, we use a lot more Teams, but we don't really see many companies now saying, hey, work from home. We saw productivity levels sort of correct, and turns out productivity levels were dipping. But that point, you can see as an example that despite everything, and I think those people are really intelligent, these are not dumb people saying this. People tend to, in every instance, in every scenario, you'll see a good amount of people extrapolate that situation and say, this is the new normal. This is how it's going to be for a while. Rates are the same thing. When rates are down, people say, this is now the new normal. This is where things are going to be. So you'll start to see on the averages, people exhibiting the behavior as if this is going to be the case. And I think that's what we saw with REITs, what we saw with variable interest. So people taking on more risks than they otherwise should have. And actually, thinking of REITs, I know that there were several acquisitions, very high profile acquisitions. And we don't even have to stay in REITs. We can look at oil, energy, or commodity businesses. It's seemingly always the case, and not to get too distracted with this, but I think it really adds to the point, because I think energy CEOs, executive teams at coal companies, for example, I think they know the coal industry quite well. I think they're very intelligent. They almost seemingly always follow the same playbook. Why do they keep making the same mistake? I don't know. But we observe that during good times, they don't hoard cash. Then they just spend it all. They either acquire other businesses at nosebleed prices, and by the way, when I say nosebleed prices, like you'll see they have really low PEs. They'll look really cheap, but that's always the case with cyclical industries. And no one's saving any money. Maybe one or two players might be saving, but no one's saving any money. Then the bad times hit. It turns out all of them are strapped for cash. No one can acquire anyone at the cheap valuations. No one seemingly now can buy back any stock. What happened? And if I told you that this happens again and again and again and again, of course, in cycles of maybe 5 or 6 years apart. So, people always say, oh, no, this time is different, blah, blah, blah. I'm extrapolating the current and saying it's in the future. REITs are the same thing. Almost every industry I look at is the same thing. I think it's the exception to the rule when you find a management team that is doing something different.
Yeah.
So
it's
yeah.
kind of a universal law of human nature almost, and you see that just
Yes.
recently with Chevron acquiring Hess, right? Like
Yes.
going through with a very razor thin margin, like 50.1% of the
Yep.
shareholders approving. Yeah. And of course now, right? Like it's at a time where, and even when oil prices were, cresting above 100 and 120 a
Mm-hmm.
barrel, right? You saw management speaking and planning as if that price level was going to endure at least above 90 a barrel for the foreseeable future. But very quickly you saw a correction in that.
That is a wonderful example, a more modern example for the audience, more current.
So, what are your thoughts on, speaking of international oil players, what are your thoughts on investing in foreign equities, such as the international subsidiaries of companies like Coca Cola that have durable brands that usually have minimal analyst coverage? Because you talk a lot about trying to gain exposure to underappreciated or hated industries.
Especially if they have a lot of, let's call, oversight from a parent company like Coca-Cola. Yes, those kinds of companies. I'm very nuanced when it comes to international investing. So it's really case by case, because I really try to pay attention to the culture. I think that investing or investors, they I'm making up words here, but I'll explain what the words mean. I don't know. This may actually be an actual phrase, but I didn't learn it. I just kind of just made it up. But Western normative mindset with regards to investing, where they take the country of origin, let's say the United States, the American investor, and says every country, therefore, because of my experiences, it operates in the same manner, has the same business culture, has the same blah 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 blah, which is not the case at all. So when you travel the world, when you talk to people and you learn about all these different cultures, very different. Some cultures, I will say, have more problematic business cultures where you have to be a little bit more careful as to what or who you deal with. Some cultures are a lot more. There's a lot more prevalency of nepotism, a lot more relationship based. And so if you're not part of that inner circle or relationship, you're not going to actually get the good deal. That can happen. So but there are businesses that in those countries that buck that trend. I'll give some examples of basically Western style management teams in operating in countries that traditionally have not had the most squeaky clean business cultures, and that's Mercado Libre or Nubank as an example. So Mercado Libre, wonderful business, wonderful management team. And I would argue that they are an example of a company that operates in a environment where traditionally, and this is always subject to change, things can improve, and I think they are improving. Um, a business that is international, foreign business, where it exhibits a lot of the attributes I would observe in a American style business, for example. Nubank, same thing. In fact, Nubank, the founder, that was what he wanted to do. He wanted to take the American culture, corporate culture of banking, and bring it to Latin America, bring it to Brazil, because a lot of Americans may not understand this because they're not from it, and it's perfectly fine. But there is a more of an inherent distrust with banks for good reason in Latin America than in the United States. An American, you say, are you afraid every day that Chase Bank is going to steal money from you? The answer will very much be no. Or if they say yes, you start poking at it a little bit more, you find out no, not really. But in Latin America, that is very much a fear that people live through. And that distrust is not crazy, it's not unfounded. There's legitimate fear. And a company like Nubank, I say this now and watch. I hope for everyone's sake that there's no scandal that turns out they were a massive fraud. So I'm saying this
It'll age
now.
well.
Yeah, hopefully this ages well. But they have seemingly bucked that trend. They've gained and the reason why they're growing so much, and that's what people need to understand. The reason that they're growing so much in Latin America is because they have basically taken the ingredients that makes banking successful and trustworthy in the United States, in the West, and just giving it to people who didn't have that before. So if people are astonished to observe Nubank's growth, and it's growing really rapidly, well, that's why. And he found the opportunity. That individual, the founder, he found that opportunity. He said, if I apply this to this, we'll be good. Mercado Libre is doing very much the same thing with commerce, with business online in Latin America, and it's also another fintech. But I like investing in international businesses. I have, currently some some bluer chip companies in LVMH, but I've been a proponent of a company called Grab Holdings in Southeast Asia. I think that, there's also even, well, we can get into China if you want to, but there's even some speculative opportunities within China that I think are legitimate versus illegitimate businesses. But yes.
Okay, so on the China point, obviously there's the looming question of like Alibaba. There's Tencent. There's sort of the massive tiger-like huge corporations in China that even lured people like, say, Charlie Munger into a Baba position that ultimately got him rather burned. So
Yes.
how do you navigate such complex and oftentimes politically polarizing landscape for investing in a foreign country like that? Because usually the precursor for me before allocating capital to a foreign nation is, like you said, you want to make sure they have a business culture, but also a regulatory environment that's at least, it doesn't even have to be favorable, but at the very least respectful of shareholder rights, if that makes sense. So I think there's a lot of concern surrounding China in the sense that you're owning an ADR, you're not necessarily owning the underlying asset. There's a lot of concern around the Chinese government could swing back in the other direction and sort of crack down on private industry. What are your thoughts on that, and what opportunities do you see coming out of China?
So the China question, yes, has been very polarizing. So I think people feel really opinionated about it on both sides. But I think that more recently it's become more popular to be anti China stocks. But I think that if you take that approach from the get-go, I think you'll save yourself a lot of heartache and mistakes of avoiding countries, environments that are just not very business friendly, where you as an investor have to do the extra legwork. I would leave it to the Coca-Colas of the world to establish subsidiaries and control the subsidiaries, and I guarantee you they'll manage it better than someone like, let's say, I want to put capital to work in a domestic business from that country in an environment that may not respect me as an investor. So China, if you want me to get into the whole structure issues, but there it's not the case. That is not the case. The opportunities in China are nuanced in the sense that what I was alluding to just now was not all companies are structured favorably. So, and I think investing is extraordinarily nuanced, especially when you invest in individual securities. Looking at China, there's what you call a variable interest entity, which is an umbrella term used to describe the structural design of ownership, and it could look in a variety of ways. And I think the Chinese version of a VIE is absolutely horrendous and an abomination. But I appreciate it for its intelligent design and way to circumnavigate the law in China. But not all companies within China that are publicly traded are structured that way, thankfully. You can find businesses within China that are publicly traded, and you can actually own shares, maybe not voting rights, but you can actually own shares of the business and benefit economically from it, or at least not worry about, not benefiting economically from it. So I have to almost go into, some of the nuances here because Alibaba, which I talked about a lot on YouTube just because it's so popular and so people resonate with it. But Alibaba is structured as a variable interest entity. What you own as an American, and even if you're buying it in Hong Kong, is literally a contract. So not, actual ownership of the business. And there is a difference between contract law and property law or ownership. And so ownership rights are much stronger than contract. And so the contractual obligations are quite, let's call, vague, to say the least. And the benefit of having the structure for Alibaba is that they can raise capital, and the capital actually doesn't come at a cost of equity ownership. It comes at a cost of an agreement of shared profits, but not actual equity forgoing. So typically when you look at debt, right, when you are investing in bonds or the debt of a business, yeah, you're not getting equity in it, but you have some economic interest in the entity through contractual obligations, and the contractual obligations have a time stipulation, meaning they have a maturity and end time. Well, with this, there's no end time. I could go through this agreement with you, and I could set this up, and you give me money, and I never tell you when I'm going to give money back to you because you have common stock in an entity that has agreements with me, but there's no agreement as to when I have to give you money. I could never give you money if I wanted to, and I would not have run afoul of our agreement. So even like with preferred stock, at the very least, a preferred stock, the rules are quite simple for the most part, that you won't get cash payments if no one gets cash payments. But if the common stockholders get cash distributions, you have to get cash distributions first. So at the very least, you're protected in that. And then again, a bond has a time stipulation
Well,
or an
couldn't you?
expiration.
Sorry to interrupt, but couldn't you say the same of traditional common equity in a business in the sense that if you buy shares in any company that doesn't pay out cash directly to shareholders, you could apply the same line of thinking, right?
Correct. However, you do have at the end of the day the equity ownership. So you own the actual business. There's an actual ownership. But what I'm saying here is you didn't get the ownership, but then you're being treated as if it was like a contract.
Yeah. Yep.
But because it's a contract, normally the benefit of having a contractual agreement is that there's time stipulations. So I'm getting the best of both. I'm not giving you equity, and I'm treating you as if it's a contract, but I'm don't even have time stipulations with you. There's no, we didn't agree to any time, but I didn't give you equity to begin with. So in the other way, I gave you equity. So that means that if at the end of the day, if anything, you are an owner of the actual business that we're discussing. And why that's important, if you look at the historical treatment of Yahoo, this is the one that people really forget, and that's what I'm talking about. People maybe have short memories, but this is really, it just happened. I think 20 years is nothing in the grand scheme of things. But in 2012 or so, the Reuters article came out. The journalist was so surprised by the following scenario or situation. So what happened was SoftBank and Yahoo owned a large stake in Alibaba. And Ant Financial, which was a business inside of Alibaba, was spun off and given to Jack Ma. But there was no compensation to Alibaba shareholders. So, to give an analogy of what that would be like here in the United States, imagine if Amazon spins off Amazon Web Services to Jeff Bezos and the Amazon shareholders get nothing. So right off the bat, that would be, okay, that's illegal, et cetera, blah, blah, blah. In China, that wasn't. And what ended up happening was, of course, Yahoo and SoftBank sued Alibaba in Chinese courts. They were obviously going to lose. They ended up settling, but I'll tell you why they settled, because, and the settling was pennies on the dollar, like literally just like a tokenized payment. The reason why they had to accept the settlement, they had to basically accept the theft. I'm going to just call it straight up what it is. The theft of one of the crown jewels of Alibaba was because at the time, and going back in history, and Alibaba as a percentage of SoftBank's portfolio was quite large. And for Yahoo, it was everything. So when you looked at Yahoo stock back in those days, and you looked at what their value on the books were, it was all Alibaba. And so what would happen if you were to admit that you never owned the assets in the first place? As in, you pursue this lawsuit to the very end. Like, you don't accept that they do this to you. You say, no, I can't accept that you do this to me. I'm going to take you to court. I'm going to fight this theft. Well, what would you have to conclude at the very end of that? And by the way, there were prior hearings that had undergone in China with other businesses. The conclusions were always the same. The court decided or said, you never owned anything to begin with. You have no rights in this court. We don't recognize any of your rights.
Wow.
So
okay.
Imagine if they went through with it. What would they have to say to their shareholders in the United States or elsewhere in the world? Oh, sorry, guys. Turns out all that value on the balance sheet, yeah, it's not worth anything. We never owned anything. We had, it's a facade. So of course, if you're the CEO at the time of Yahoo, what are you going to do? Of course, you're going to take the deal. You're going to keep the facade going. You're incentivized not to admit that you owned nothing. You take the chump change and you accept the theft and you move on with your day. And later on, Yahoo spins off the Alibaba ownership in an alternative entity called Alt-Aba, which is no longer publicly traded, because thankfully they did good by their shareholders, by the way. They kept the facade going as long as they could, and they liquidated. And they liquidated, I think, in 2019 or 2020. So I could be off 1 or 2 years. The time starts to get weird after so many years. But
yeah.
They're no longer with us. And actually, if you own that entity through and through, you ended up doing fine because they liquidated at a right time. If they had held on, you would have not been happy. But that's another story. So,
what opportunities do you see based out of China currently?
I think that if you're looking at it from a trader's perspective, there's a sentiment trade to be had. Right now, China is hated. I think it deserves it, but the market does not treat it the way it should be treated. In fact, if everyone thought like me, the way I know market participants are definitely not thinking like me, I think that they're not worth zero, but they're worth close to zero. All of the VIE assets, they should be worth close to zero, because there's always the chance that there's a regime change and the laws change, and then they will recognize all those shares as actual ownership, and there's going to be some convergence. That could happen. So, but there's also the fear that, of course, there's going to be some sort of geopolitical conflict. If that happens, anything that you buy within China, even American businesses, assets within China, all that's should value it at zero. But if you want to bet on peace happening, there are assets in China that should or could lead to really good returns. I'll give one of the ones that I recently discussed was Yum Brands China, Yumc. So here you have a business, and by the way, you've this is actually another point to hit home. You will see the difference in how they treat shareholders depending on the structure. So if your audience pulls up while they're listening to this, or you can just trust me on these numbers, if you pull up Alibaba or JD's balance sheets right now, and you see how much cash they have versus debt, you'll see they have a massive net cash position, and they just issued more debt, convertible notes. Jim Chanos is on this. Some people have mixed feelings about Jim Chanos, but in this, me and Jim Chanos are actually in agreement on. But it's very suspicious. If you're looking at any business and you see a massive net cash position, and you're trading at the cheapest valuation that you've ever traded at, you would think, oh, these buybacks, they should be going crazy with these buybacks, but they're not, which is a red flag. They're doing some buybacks, but not as much as you would think. And they have a massive net cash position, but they're doing a convertible debt offering. So something's weird. They have way more cash than they could ever need for reinvesting back into the business. They're producing tremendous amounts of free cash flow, and I'm assuming all the numbers are correct. Something's weird there. It doesn't check out. I don't see this behavior with any kind of business anywhere in the world, just here in this country where there's this weird structure. And I'm looking at another business, Yum China, where they are putting almost 100% of the cash flows that they generate back to the shareholders in the form of dividends and buybacks. And they're not structured the same way. So basically what I'm getting at is you probably will do better if there is peace and the sentiment reverts in names like Alibaba, but just I wouldn't be comfortable owning them in a serious way because I know at the end of the day, I don't own anything and there could be something really bad that's like a gray rhino that occurs with that. But with at least Yum China, I know that my incentives are at least aligned. I actually have ownership in this thing, and if I bought shares of Yum China, it'd be basically making a bet that there will be peace. Because if there isn't peace, if there is something, first of all, a lot of other names in my portfolio are going to be cratering, but I would value Yum China basically at zero. It'd be the equivalent of your ownership stake in Gazprom if you bought Gazprom right before the Ukrainian war. Same thing here.
So how do you go about positioning if you did think there was going to be military conflict with China?
So that is a very interesting war game scenario. Not war game as in the war, but just war games in general, strategy for the portfolio that I've been thinking of. And right now I've actually started to try to position myself. I mean, nothing beats treasuries, right? If you're really scared, nothing beats treasuries, just saying that right off the bat, or CDs, short-term treasuries and CDs. But if you're trying to play equities, beneficiaries in the equity space, I mean, you could go military defense contractors and maybe make an argument for pharma. Companies that do not care what the economy is doing, et cetera, and their cash flows are going to be relatively secured. But frankly, I don't think there was going to be anything off the top of my head. Like I even think that we could see a sell-off even in military defense contractors. So like I said, I started off by saying nothing beats treasuries. In a war, yeah, like if you're now saying, because the Russian-Ukrainian war was one that we're not directly involved in. This one may be, and I don't want to be a warmonger, sound like I'm a warmonger, but maybe this one will involve the United States in an active conflict.
There's lower risk of a direct nuclear exchange.
Yeah.
So the possibility of a conventional war becomes a lot more viable.
Correct. And I mean, in both conventional war in the across Taiwan would be have a lot of implications around the semiconductor space, because one thing people don't know, it's not just Taiwan Semi. If you talk to semiconductor engineers, they'll tell you all about the very delicate supply chains that makes up the entire semiconductor industry, right? The semiconductor industry relies on the existence of regional peace, because there is so many, like in some countries, there's like very important but small crucial players that they're in that country. And now all of a sudden you say there's war in the South China Sea. We may not get that one component, and you might not have been thinking of that one component, and now the whole thing is under question.
Hmm.
So, I mean, I'm looking at my portfolio and I'd say, yeah, Taiwan Semiconductor, that would probably be either the generational buying opportunity, like a true generational buying opportunity, betting on on the other side of this thing, there's peace and it could be dead money for 2 or 3 years. Um, or, it will be, let's say, potentially how you're positioned, very painful and just painful. No opportunity, just pain, permanent loss of capital. So, yeah,
Gotcha. I
it's
understand. Okay, so sort of piggybacking off of that for our final question, what are your thoughts on the potential for deglobalization? This is something that's been talked a lot about
mm,
with the works of Peter Zeihan and other thinkers and whatnot, sort of stating that the trend of rising global trade as a percentage of global GDP has started to reverse to some extent, especially post COVID. It showed how fragile a lot of international supply chains are. There, for the first time in a long time, there's sort of the end of the peace dividend, rising military budgets in Germany, with companies such as Rheinmetall being a beneficiary of that. And you're also seeing increased US energy independence, resulting in lower rates of intervention around the world, because to some extent, we're no longer dependent upon the Middle East for our own domestic energy prices. So, do you think that deglobalization poses a threat to companies that are largely dependent upon international commerce and trade in order to drive earnings growth? Do you think that subsidy initiatives are going to benefit companies like Intel that are trying, the United States is trying to prop up its own semiconductor industry? In the event of, say, a war with China, it has a more secure supply of resources. And just beyond military conflict, do you think that deglobalization poses a threat to the current global economic order?
so I think deglobalization, yes, it's something that it's going to happen. I'm a huge optimist in this new shift. So I'm generally an optimist. I just want to state my bias to the audience. I'm not a pessimist. So if I'm looking at, what's going to happen to, let's call it profit margins, I actually think profit margins are going to remain flat, if not maybe even still go up. I could see the argument why in some industries it could decline, but the way I see the change, and I could be wrong on how this actually ends up being, but deglobalization is not going to be complete isolation by country by country. It's going to be different, economic zones. So with United States and various close allies that we're going to maintain really strong relationships with. It's not going to be United States only by itself, but we have many adversaries right now that we do business with. We trade with, we rely on them, or they rely more so on us. And I think that's what's going to come to an end. I think the United States and all of it is through human innovation, frankly, and through just actually, you could argue, sheer luck that the United States has the resources that it does as well to kind of get through this period. That United States is going to be in a very strong position to change its own destiny, choose what happens to it. So if you can't tell, I'm very bullish on the United States, but the likes of Mexico. I think with Mexico, we're going to develop even closer relationships. That's the trend that's we're seeing in exports from Mexico have actually already surpassed China. So we're trading more with Mexico than we are with China. I believe that's going to continue to be the case. I have an investment, for full disclosure, in Canadian Pacific because I think that's actually going to be a strong trend. I think with Canada, if we look at Canada, we're going to develop stronger ties with Canada. With varying European countries, we're still going to develop really strong ties with them. I don't think we're going to loosen up and separate away from them. But for the likes of, yes, we're not going to allow the Middle East probably to bully us anymore. We're going to have a lot more security in our energy. And that doesn't bode well for many of the Middle Eastern powers, sure, but that's in a sense, I don't view that as a bad thing. That could make them more insecure. It could increase levels of instability because now if you're saying that these autocratic regimes may not have the same leverage that they once had, okay, yeah, that's a problem for them. And yes, that could cause maybe instability, conflicts, etc. And kind of extrapolating that from there, I think for the Russians, that was in a way, if I do say so myself, is causing the anxiety between the Putin administration and why they are doing what seemingly really crazy, almost death throes of a country. And I fear to say that that may be also something that we observe with China, that the autocratic regime within China starts to get a little nervous by, the changing winds and they're not an open and liquid currency, or they don't have an open and liquid currency, and their economy is very reliant on the United States.
And they're
So
also
those
suffering
prospects,
from cyclical demographic decline as well.
yes.
That's
It's
a major contributing factor.
yes, and there's no fix. How do you fix that?
Yeah. Well, I mean
Force.
that's an issue that the entire world is kind of facing to some extent. Obviously, the U.S. to a lesser extent because we're able to integrate immigrants into our society more
Mhm.
effectively than most nations. So we're able to, pull people from say the traditional third world, integrate them into the labor force. We have an abundance of low skill labor, so on and so forth. Um, and we have that sort of unifying American identity. But many countries like Italy, Germany, Sweden, etc., Japan is one. Japan is a highly ethnocentric nation that's very homogenous
Yes.
in nature, and they are suffering from the steepest demographic decline. And when you look at real GDP growth, I mean, they've had almost none for 20 years. So, and part of that obviously is, the bubble that they had in the 80s and recovering from that. But the reality is, I mean, demographics are to some extent not destiny, but they definitely do dictate things, right? So,
Yes.
do you think that demography is going to play a critical role in investing? Because a lot of assumptions that we have retained from the 20th century, like equities will usually yield about 8 to 10% per year, are sort of built in with the assumption that we're going to have continuous population growth, with which just factually we're not, right? When you look at birth and death rates, like globally, by the end of the century, we're going to have a declining population. China is going to have less than a billion people if you believe current UN projections by the end of the century. So, and they're also going to have one of the highest dependency ratios in the world. So, I mean, do you think that the presumptions that investors have grown accustomed to are going to hold? And do you think that equity markets will continue to yield in that traditional range of 7 to 10%?
I am a skeptic on the 7 to 10%. I do consider myself part of that camp. However, I think that there's plenty of growth still to be had, depending on how you're exposed. I think, for example, there's two ways we grow. We grow through just raw, volume, as in population, et cetera, but we also grow through productivity gains. Productivity, let's kind of take a step back and say on the individual basis as a consumer. So consumers, depending on where you're looking at in the world, have different, it's called economic value. So a consumer in Latin America versus a consumer in the United States. If you look at the average revenue per user for some of these companies, an American consumer is much more valuable economically speaking than one in Latin America. But let's say if you start to see wealth increase or wealth improvements in some of these countries, even though the populations may not be growing, but the wealth is increasing because due to productivity gains or something. And I'm saying the something to that's my optimistic spin. That's something that we may not foresee is occurring. But let's take actually more closely Mexico as in a real world example. So Mexico's demographics, yeah, they're not improving as they're not amazing, but they're good. They're fine, and they're not. We're seeing the lowest form of migration from the Mexican citizenry and nationality to the United States than ever before because things economically are improving in Mexico. There's a lot of bad things in Mexico, cartels and stuff, but things overall are improving. The country's actually getting richer and richer and richer. And so I think that we'll see the uplifting of a lot of consumers in the future more than what we might even think about. So there's still growth to be had if the overall wealth of nations is growing alongside it. You might see some countries sort of like taper off or flatline, so to speak. And I think some European countries are guilty of this, where they're not improving; they're kind of just in stagnation. But I think for every stagnating country, there's another country that's on the rise, on the up and up. It could take some time for continue with the example of Mexico, for Mexico to resemble let's say even one of the poorer European countries. Fair enough, like Spain. It's going to take a time for Mexico to look like Spain, but I don't think it's going to, let's say, we're going to see enough of a decline in a country like Spain to where it nullifies all the gains of countries like Mexico or countries like even India. China, their issue, I think, thankfully, is going to be a lot more isolated. It's going to harm a lot of American companies, but their issue of the consumer not maybe being as strong as it might be is going to be more so akin and isolated to China. Thankfully, because the United States hasn't really tied itself in terms of dependence to it. There are companies that if the Chinese consumer does not do well, their stock prices, yes, will have a temporary collapse. I'm looking at the likes of Apple, uh, even Tesla, Starbucks. Even if it's not necessarily rational for them to collapse on that or fall a lot on that, just the sentiment, could drive temporary share price weakness. But I think longer term, that's going to be an isolated issue, thankfully, because we're not tied. The United States, if I had to do like a an overarching theme here, we are the uh, consuming or the consumption of the world. And so we're in a really good position because of that. We're in a wonderful position because of that. And thankfully, most of the American businesses that we think of that make up the majority of the index, they're massive value drive is still going to be from the United States and then many of our allies. If they lose some of our adversaries because things kind of tighten around the world, I actually don't think that's going to be an issue at all. Well, for example, in China, we don't even like Google doesn't even operate in China. Meta doesn't even operate in China. Amazon doesn't even operate in China. So do they even care that the likes of China falls off? And China isn't a
Well,
massive.
they're sourcing, right? I mean, a lot of the goods that are in or listed on Amazon are going to be extremely negatively impacted by that, right? Because the overall price level in the United States is going to rise since they are to some extent the workshop of the world, no?
Yes. However, that's replaceable.
That's
How do you
true. Yeah.
replace the
Yeah.
consumer though?
You really can't. I mean, I think another thing that's worth noting, though, is you use the term stagnating demographies. You see a flatlining of the total population, that can be a little bit deceptive. Because really, what you need to pay attention to is the overall dependency ratio. Because the ratio between the working population and the extreme young, in the instance of a nation like Nigeria that's growing very rapidly, or a country like Japan that has a very elderly population, if you see a flatlining, meaning that people are being born at about the same rate that they're dying, and you have sort of that column like demography, you're usually going to see a gradual inversion of a population. In the demographic transition model, it's usually referred to as stage 5. And once you reach that point, you can have a flatlining total population for multiple decades at a time, but your dependency ratio will still be increasing. So an overall flatline in population can lead to the death of, functionally speaking, the death of an economy. And the other thing is it's very difficult to recover from demographic decline in the sense that a lot of people don't realize, like, for instance, if you were to have a birth rate of 1, you're seeing a halving of the total population of the following generation,
Yes.
right? And if you were to have a birth rate of, say, zero point 0.5, like Korea is forecasted to have, if you maintain that over a long enough period of time, by the end of the century, you would have basically a 96% extinction rate relative to the current population of Koreans, which is rather horrifying. I mean, think of the economy, right? With
Yes.
96% fewer. Think of your school that you went to high school in, right? Imagine if 96% of the people that were in attendance were not there. I'm sure there were some people that you certainly wouldn't miss, but think of that, right? Think of that, right? Like it's a completely different experience. It changes the way in which we live life. And another thing that you mentioned, right? Like the concept of increased trade with Mexico. A lot of that has to do with the fact that Mexico has a very compatible demography with that of the United States in the sense that it has a lot of young workers and a very small elderly population because the life expectancy for a very long time was a lot lower. And currently, it's very compatible in the sense that it can act as basically a manufacturing hub in the same way that China had similar demography.
There's not to get into like maybe more because people might view this as more of a political discussion, but the I think one of the major changes that we've observed is like the exact structure of how we've structured society. You said dependency ratio. Well, dependency ratio matters in the sense that we have a system designed that the young take care of the old, but in a systematic format, which is you pay into the system and then the system takes care of the elderly. And then that also puts what we were talking about maybe, but we didn't get into the exact into is like the burden that's placed on the younger folk to take care of that elderly population. While before we call it World War II, the incentive structure was very different. In fact, you could say if you looked at families prior to World War II, there was a economic incentive to have kids. Why is that? Because if you didn't have kids, had no one to support you in your elderly years. And so you had two incentives working for you. And I say this, I don't know your background, but I'm Venezuelan for the audience who may not know this. So the cultural different, I very much come from a culture where that's still the case. If you look at family structures, it is very common for the younger to take care of the older, but within the family, not that the system or you rely on the system to take care of your parents when they're old. You take care of your parents. So your parents have a couple incentives. They have the incentive to have kids. Why? Because you want to economically. We're talking getting the emotions out of it. Oh, I love my kids. No, economically, money's on the table here. I need to have kids. Why? Because they're my retirement. Okay, what's the second thing? I need to have a good relationship with my kids. Why? Because if they don't like me, they're not going to pay for my retirement. So it provides. We're kind of taking a really big step back here,
Yeah.
and maybe it's not the perfect description of what's wrong, but I sometimes think about it for fun as is that something that may have caused this change in society? Maybe I'm wrong. Maybe that's not the case, but I can't help but think that that's a contributing factor because I listen to a lot of the people my age, older than me, who don't want kids. Well, one of the major reasons is yes, economic, but then some people say it's because it's oh, there's more freedom not having kids. You can do all the things you want. What would happen if it was turned? What would happen if it was economically incentivized to have kids? Why? Because if you don't have kids, who's going to take care of you?
Yeah, and
Right.
to a certain extent, the government safety net can only hold for so long, right?
Yes.
It's impossible, and you're seeing in France, Japan, many other nations, you're seeing the retirement age gradually increase, and eventually they're just going to have to make some very hard cuts and very difficult decisions. So I think that the United States has enough time to react, and we have enough time to change course. But many other parts of the world, like China, like Japan, will really struggle with that, especially if they have highly restrictive immigration policies. So,
Yes.
how do you think that in a deglobalized, sort of shrinking population world, an individual should go about allocating capital?
I think that even within countries that we're describing as having problematic demographics, there can be really good investments because we are still, despite we're talking earlier about reshoring, et cetera, we're in a globalized economy. We're never going to go back to companies only dealing inside of their own country. Let me give examples of Japan. Great businesses in Japan that I think if you ever saw at crazy low valuations, buy it. I don't care what the demographics of Japan are doing, buy them. Think of Toyota Motors, like wonderful business. I think they're going to be around for a while. I don't particularly like car companies, but let me give you some other ones. Sony, Nintendo. There's really good businesses within Japan. Just to name these as a few that if the valuation is right, I will buy them regardless of it. And they could be that, trading down because the broader sentiment in Japan is poor because the let's call it market participants are paying attention to that broader theme that is legitimate, but everything is thrown out with the water. The baby's thrown out with the bathwater. And that could be an interesting opportunity to pick up. I think alternatively, if you want to bet on, winning themes in the countries that are probably going to be the beneficiaries of all of this, you can think of banks. Banks are a really good way to capture the economic development of a country without picking an individual name. You get economic participation of many of the different business entities. You could think of infrastructure plays, like, I give specific tickers, which I think your audience might appreciate, but like CP, ticker symbol CP, Canadian Pacific Kansas City. They are going to be a major beneficiary of the United States more reshoring and
Hmm.
increasing relations with Mexico.
Are you concerned at
Uh,
all about their rising debt levels? I mean, Canadian
uh,
Pacific is leveraged pretty heavily, right? I think they're at 4x annual net income
yes, and,
or
and
five, something like that.
I'm not too concerned because I do think that the forward take rate that they're going to be generating from their rails is going to be not much higher, but higher enough, materially higher than it is today. I think that the volume that they're going to be transporting on the rails is going to be increasing quite nicely, and then they're going to therefore you're going to probably see improvements in just top line and then therefore bottom line, and that's not going to be that much of an issue.
Fair enough. Okay.
Also, their cost of capital is pretty low, so it's not too much of a concern, and though their maturities are also very good. So
Okay, so
they're at
Canadian Pacific.
Canadian Pacific. You could think of also infrastructure plays that I think are I don't currently have a position in, but I do really appreciate. I may re-enter. It's a company called CRH, real big beneficiary of infrastructure development in the United States. It's an Irish company, by the way. So I'm looking at a company that's the company that's from a country not from the United States, but yet is tied to the destiny of the United States. And for the longest time, I know that it's unfortunate we're having this conversation now, but you go back 2 or 3 years ago, this thing was trading extraordinarily cheap. It's still cheap, but extraordinarily cheap, just because it's Irish. It was insane. I can't explain it. And the massive run up you saw recently was because they listed in the United States. That's it. That's all that changed. That's all that changed. So you can kind of see how sometimes the just where a company's listed may affect the valuation. You can take advantage of that. And even though the business itself, it was doing all of its business within the United States. The United States was its most material geography. So it's an American business through and through for all intents and purposes. It's just from, Ireland. There's companies like that buck the trend, not buck the trend, but they are international businesses like LVMH. I don't consider LVMH a European company. I think it's a global company. It's not just a French company. And even though France has bad demographics, I think if you, for whatever reason, saw LVMH, trading stupidly cheap because people are concerned about French demographics, you buy LVMH. That they're I mean, look how much they draw income from just the United States. It's like,
Yeah, it's a
so
globalized brand.
exactly. So that's what I'm trying to get at. Is like you can look for companies that are from these countries that have problems, and you may in fact find that they are trading at a discount, and you can take advantage of that because the just everything is being thrown out in that area, and this company is a global company, and you don't have to worry about that necessarily.
You want to bet against the overall market. You want to allocate capital away from the general public. You want to be aware of litigation or events that can potentially
Mhm.
weigh on future earnings because the market doesn't like uncertainty. And you can
Yep.
capitalize when they become overly pessimistic. And also take advantage of undervaluation driven by a lack of understanding, being in a foreign market, a lack of analyst coverage, and to look where others will not.